Have you thought yourself personally what that policy might be? If you're in the driver's seat, if you were at the CSRC or you were, the regulators, even the Treasury, what would you do if you're an advisor, if you had the ability to build a program?
Yes, I do have one. If I was that someone, I would do it. But unfortunately, they will never do it, which is to lower tax. Easy, right?
Xin, in the news this morning, in fact, there's some bullish discussion about the government setting aside an organization, a unit, to purchase or to buy out some of the non-performing assets from the market. And this would create a slight tailwind for some of the stocks onshore. What are your thoughts there?
This is, I'm sure, in our industry, we call it the Singapore model. Now, the government may not like to call it that, but basically, in terms of the idea stage, I think it's a great idea, right? It's the government buying these already built property or apartments at a discounted price, and they will turn it into a low-income housing or low-income rentals, which is great, a good idea, but it is up to each city and each province to execute it. The central government may give you kind of direction, but it is up to the local government to execute it. But in general, it's a good idea. Now, coming back to the earlier question, we will ask ourselves, how do we participate? Now, like you said, if it start turning positive, so what we did is, we can choose to spend a lot of time and figure out which real estate company developer is the least affected and has the best land or apartments to benefit in the upturn. But we didn't do that, actually. What we said to ourselves is, even if you buy a new house, you need to renovate, right? If you even buy a second-hand house, you need to renovate. So what is the target company or stock that we can buy that's safest and will benefit if indeed the volume within the real estate industry turns up? Just to explain to you what we found. We found one stock. It's called 𝗏𝘃𝗀𝗃. In English, I think it's called Bow. It's a brand. They actually made money. Their claim of the fame is making power outlet, like extension cord. They are number one in China. And their distribution channel is the mom and pop small construction material shops by the street. And 10 years ago, they extended into something related to real estate, which is to make light switches, control panels, LED strip lights, something to do with real estate, but not full in. And the latest business segment that they entered is to make these EV chargers. So instead of buying from the EV manufacturer like BYD or Tesla, you can buy a Bow branded charger. So that they have three line of business. We thought this company is perfectly situated, right? If the real estate market doesn't go up, then they have the support of their own business, the extension cord business, as well as some growth from the EV market because they are a name brand. If the real estate market does do very well, they will benefit tremendously from the second line of business of making light switches and control panels for, for floor heating, something like that. And their valuation is roughly about 15 times EV/EBITDA. So it's not very, very cheap, but they're growing about 10 to 15%. So it's more like a compounded. It's a proven business model. It's a proven case, right? They have done it very well with extension cord. They have done somewhat well in the construction, in the light switch arena, and they are doing the new thing with EV. So it's a proven company. It's a very large company as well. And if you, let's say some investor sitting in the US or Europe and saying, okay, 15 times a little bit rich, and I agree. So let's cut it in half, right? Let's find something that's either seven times EV/EBITDA arena. And we found one. There's a stove manufacturer, the largest in China. The Chinese brand is called Laoban. All right. And the
Boss.
English brand is called Roban. Roban. Okay. It's not
Okay.
called Boss. It's called Roban.
Roban.
And they are
I love that.
and they are the largest in China. They have a very close second competitor, but they're currently the largest. 7 times EV/EBITDA, no growth. The reason why they have no growth is because a very large portion of their business is B2B. Usually it should be B2C, right? In the US, if you buy Whirlpool or GE, it's B2C. But in China, because there's such new developments in the last few years, so the likes of Evergrande will talk to Robam and say, okay, I feel, apartment blocks, I need it furnished. The kitchen needs to be furnished. So Robam will supply. Now that's a dragger on their financial performance for the past 2 years, right? The accounts receivable are huge, some inventory, and at this moment, I think Robam is a good buy as well, because there's enough time has passed already for investor in the market to ask the company, what have you done with these receivables, right? Okay, are they in court? Are you negotiating with these developers? What have you done? Are they written down? Okay, so the case for Robam is that indeed they have done something. Most of these receivables have written down. In fact, there's a large section in the annual report that explains what they are doing with it, and it's turning positive now. So they are getting 2, 3 apartments in lieu of the receivable that's on their books that's already written down, right? So they're doing something about it. And also we have to consider margin of safety, right? So we evaluate the B2C part and see if it's healthy enough. And again, if the real estate market turns up, they will be a huge benefactor, right? Even for the secondary, right? Even if there's a lot of volume for buying, selling of used apartments, second-hand apartments, they will be benefited. Now, if you say, okay, for the China, there's China risk, nobody can explain the details, but I feel uncomfortable with China, let's say, cutting half again, okay? We can have a 3 to 4x EV/EBITDA company, I may add, in the same industry as Robam, all right? It's a company called 𝗜হি, and they have a much better English brand now. It's called Vatti, Vatti. It's a listed company. Robam is in the Yangtze River Delta. Obviously, they sell countrywide, but they're based here. And Vatti is Pearl River Delta. They are based in Guangzhou, very close to you. It's a very good company. They have zero B2B, almost close to zero B2B. So everything's B2C. They sell through the Best Buy equivalent in China, okay? And they have their own store. And they have some export, which is a plus in this time. They have some growth, 10 to 15% growth in the latest quarter. And they're trading at not over 4x, okay? We bought it at 3, a little bit over 3. It went up a little bit. I think it's less than 4x EV/EBITDA. That, intrinsically speaking, I think it's cheap. Obviously, I'm not going to spend a lot of time discussing a lot of details about this company, but they are maybe number 5, number 6 in the market, selling same stuff, selling stoves, integrated, or I don't know what you call it. When you build your kitchen, you can embed it in the entire kitchen. So they do both, just like Robam, but they are number 5, number 6 in the market. So the discount is reasonable, but it's 4x. Yeah.
No, these are steals. And these are not micro-cap companies by any measure, right? These are top ranked.
They're large.
Yeah, these are massive.
From my memory, Robam EBITDA is 1.8 billion. EBITDA, 1.8 billion RMB. And I think Vatti is less than half, but more than a third of their size in terms of EBITDA. So it's not small. Yeah.
When you talk to investors these days, and I'm kind of hearkening back to not just your 2019, 2020 years where you did exceptionally well. This is still very much late in what some would have called China's golden years. And even at that time, many were saying that, China was looking at a decline, so to speak. At least expectations for growth should be tempered. Now, a lot of the stocks that we've been talking about currently are actually very, very strong. RV, a very great value. almost not necessarily growth at a relative value, but very, very strong balance sheets. And I wouldn't call them cheap, but certainly undervalued to some extent. Now, when you talk to investors today, how do you manage their expectations for China as a return profile? And I ask this because historically, China has been a, high, very spicy, high yield play, high growth play type of environment. You're riding on the maturation of a developing country into a developed country. Things have kind of changed now. It seems that there's a growing narrative that China's moving into a more sustainable, lower growth type of environment. Is this consistent with how you're discussing or talking about the topic with your investors?
Just like you said, I think that this narrative of the story is changing. I prefer not to change the story, but structurally, the Chinese economy is changing. But we are at a point where the Chinese equity is really, really attractive. So that's a benefit to have to kind of enter at this point. But on an ongoing basis, we think the volatility is going to stay. That's just because the participants of this market, right? It's 80% retailers. Again, in China, locally, there's a saying, right? 3根阳线改变信仰. It means 3 uptick, it's going to change your religion. So right now, people are holding cash in the bank and not participating in the stock market, even with the uptick, right? There's a lot more cash in the bank.
40% savings rate in China. Even now, there's still 40% savings rate.
Exactly. And when these people come in, there will be tremendous amount of volatility. And it is very difficult to manage with the tools that's available in Asia. But I will also add, we are a long-short strategy. The shorts, our hands are tied in terms of practice, right? In terms of the regulatory framework, it's already there that we can short. But the availability and all that in practice, it's very difficult to do. With lack of tools, I think to navigate this upcoming volatility won't be easy. It won't be easy. And the number one thing to counter that, in our mind, is to find good company, right? If the valuation elevates, we still have to invest, right? We will be disciplined about it, but still we have to invest. But we rather invest in higher valuation of a very, very, very good company rather than play these themes. This is like the flavor of the day all the time, right? There's also another saying in the local market, right? 𝗁〗𝗁𝗁𝗁𝗁𝗁. Purposely, they're going to buy new stuff with new IPO, buy poor company purposely. 𝗁〗𝗁𝗁𝗁𝗁. Anyway, you get the picture, right? It's smaller company is easier to speculate, right? Yeah. I will also add, while we are on the subject, this information is very helpful. It was helpful for us. I think it will be helpful for your audience, which is we touched upon how the Asia index dropped a lot. Readily, we can find very attractive targets at this point, even with, it has gone up 10% about. But index is an index, right? You have 300 company in there, you have 500 company. It does not represent the entire market. Actually, there's an index in China, they call it the microcap or something. They have a name for it. But the way they make the index is that every day they pick the bottom 400 company by market cap. This is not a real index, right? You can't trade it or anything like that. And then they make it, they check the performance, they record the performance of that 400 company every day, and they made an index out of it. So if you check that index, it has went up, let's say from 2019, probably doubled. So when we are having a difficult time in 2022 and 2023, it went up twice, right? These micro cap companies, okay? But in a week or so, week plus maybe week and a half, in January, remember the big rout in January? It was the drop of those companies. So a week and a half, that particular index, the 2 years return of, double return dropped in a week and a half and all gone in a week and a half. Obviously, if you look at the major indexes, it's still down. We are affected, much less so. The index went down. I think the index in January went down maybe 6%. We were down maybe a little bit less than 3, like 2 point something. But the micro cap index dropped cut in half, I think.
Yeah, it's like the shit coins or meme stocks, right?
So the point I want to make is, there's a lot of individual investors in those shares. They are speculating. So is China cheap? If you're careful, you can find cheap and good stocks. But if you're not, you could be buying one of those 400 companies, right?
Yeah.
And they will be very expensive, fundamental, very poor, but it may be flavor of the day. Maybe it's AI, maybe it's robots.
Yeah.